Howdy there, folks. Welcome into today's video. It's a buy one, get two free in this one. 3 videos for me to react to. First one up here, Oracle. I've been spending a lot of time looking into Oracle stock here recently and trying to figure out if this is a steal deal of the stock. Valuation looks pretty compelling. Numbers look pretty compelling. The financials look pretty compelling, except for the balance sheet is a little rough. So trying to figure out if Oracle is a steal deal or not. So looking forward to reacting to this interview Kramer did here very recently with the Oracle CEO and see what she has to say. Then the Professor Jeremy Siegel. We're going to hear what he has to say about the market going into year end and a few other subjects. And last video I want to react to is this one from 4 hours ago. Ed Yardeni on Bloomberg speaking about the let's call it the new economy and the new normal for the markets overall. So appreciate everybody joining me as always. Thanks so much for being here, folks. New all-time high subscribers in the history of the channel. Before today's video is over, if you have been investing for 3 years or less, check out my free workshop I got for you guys. That will be pinned comment down there. That goes over all those subjects right there. Once again, that is pinned comment. Alrighty, guys, let's get into this.
Jim, and feel free to call me Safra.
Well,
We've been meeting quite a bit, so.
You are Safra from now on. Now, Safra, you're at your incredible Cloud World festival. I'm going to call it a festival. And please tell me what the buzz is about Oracle. Does it include Microsoft? Does it include NVIDIA? And just tell me about what's going on there right now.
Well, there is so much going on. Of course, we have thousands and thousands and thousands of our customers here, and many of them are talking about how they use OCI, how they're using our AI capabilities, how they're using Fusion. They're talking about our special relationship with NVIDIA, and of course, our special relationship with Microsoft that Larry and Satya announced last week. So we have so much exciting stuff. We don't have enough time tonight to talk about it.
Well, let's talk about what happened on the day when you reported the stock had its worst day.
That came across as so fake. Oh, come on. So fake and so phony. Stop it.
Worst day since 2002. Yet you and I both know that there was a moment where we were shocked because there's so much good news. Maybe you can just refresh people about why that may have been a wrong judgment by the stock market.
Well, you know, the stock market over a long period of time ends up being right. But at any one moment, it can be completely off. I mean, imagine our OCI business grew over 60%. Our cloud business over 30%. Our overall business over 9%. Our earnings 16%. It's kind of a moment. We were a little bit surprised, but you know what?
Those numbers she just went over there, very important. Those are the numbers that has attracted me to the stock to start doing some research and trying to see if this is a steal deal or not. And then I looked at the valuation. And I was like, it seems pretty darn compelling. And so, yeah, that's why, man. And those numbers are pretty darn impressive, especially in this environment. To get those sorts of growth rates out of some of those businesses there and to be trading at the P's this stock's trading at, it seems intriguing.
We continue to grow. We continue to accelerate in our growth. And we know that our shareholders are going to benefit enormously as we continue to do our job, which is to help our customers do more, spend less doing it, and move to the cloud.
Okay, so you did say at the end that your level of demand is stunning. Stunning is the only word I can use. And yet when I read some research notes, including a downgrade by JP Morgan and a lukewarm piece by Stifel, they're talking about limited AI. They don't see a lot of visibility. And they're surprised that if you have such strong demand, why you're not spending more on CapEx. So how do we juggle these two visions?
That's a good question.
Well, first of all, we spent a lot last year in setting up the basics for our clouds. And now as we expand, we start filling them up. And to spend just as much filling up a center as you did in the initial is amazing. It means we are filling up centers around the world with computers. And so for us, we have so much demand that we just keep booking it. In fact, in the first week of this quarter, we booked another $1.5 billion just in AI workloads. And we keep winning every single competition against others because our system's so much newer. We have access to the chips. And so because it's so much newer, it is much faster. And as you know, in the cloud, time is money. So if you can finish a workload, whether it's training an AI, large language model, or using it for other purposes, if you can do that faster, let's say twice as fast or often more than that, you pay half as much. It's one of the reasons that the AI startups who compete heads up, all the hyperscalers are picking us. And so we're just rolling out and filling those data centers, and it costs a lot, but remember, we build our own computers, we've got everything optimized, and it's much, much faster.
Now, Lefebvre, I think there was some disappointment in the way that Cerner's...
Now, let me tell you one of the overhangs for Oracle stock, okay? And it has to do with Larry Ellison, big dog, okay? So Larry Ellison obviously is not the CEO of the company nowadays, but he's still very involved in this company. And here's the deal, okay? Larry Ellison, in regards to his stock position, he's sold a lot of stock recently, okay? And so that's one of those things people look at and they're like, why is Larry Ellison, selling so much stock? Why not just hold it all, right? So, and that's a question we never know, right? And obviously he still holds a lot of stock overall in regards to Larry Ellison, right? Let me check Larry Ellison's age real quick here. So just check Larry Ellison's age. He's about to turn 80 years old, right? So obviously when you're 80 years old, you don't have all the time in the world, right, on your hands. And when it comes to Larry Ellison, he definitely has expensive taste. He likes to do some very expensive things. His homes are insane. He's got these crazy boats and yachts and all types of fun stuff, right? So at the end of the day, if you see the man sell $1 billion of his stock, he's actually a relatively small percentage. So I don't know if you can draw any of the biggest conclusions from that overall because, for people that like to spend a lot of money, by the time you get 80 years old, you want to spend your money. You know what I mean? At the end of the day, does it make a difference if Larry Ellison, holds an extra $1 billion or $2 billion of stock? It really doesn't, right? But I can tell you there's a lot you can buy in this world with $1 billion or $2 billion. That's one thing for dang sure, right? So, yeah, just kind of my thought process in regards to that.
Accounted for. I know that you had to go that radically because obviously it's not a licensed business. I know Cerner is a robust business. I have to believe that you're winning some big contracts, and yet people keep saying they spent $28 billion and they got very little in return. Can you explain to people why Cerner can pay off?
Cerner for us is an opening for us to bring healthcare, which is an enormous market, into the 21st century. And the Cerner we bought is still the international leader in electronic health records. But what we need to do is both use all that data and help hospital systems and countries move all of that data to use AI and actually help save lives. So instead of the decades spent by doctors making sure billing codes are correct and administrative things are done, yes, assume that's true, and we'll continue to do that. But imagine helping save lives. And that is really where this is going. In fact, this market is so enormous that, as Larry mentioned on the call, we've been chosen for $2 billion contracts in just the first few weeks of the quarter. Again, for $1 billion contracts to bring healthcare to the 21st century. And we have really unlimited capabilities in that area. So yes, we don't recognize a lot of that revenue up front, but over time, that's where the big payoff is. Remember, we didn't want to leave Cerner just as it was.
So one of the problems here, okay, one of the problems with this interview by the CEO, and I'll say she's doing a very okay job in this interview, but certainly not a great job. One of the big problems I'm seeing is her not giving enough real world examples. You gotta, to have people mentally picture what Cerner's going to do, for instance, right? Give some specific examples. You can't just throw out some general things about we're going to bring it to the, we're going to transform and we're going to AI and we're going to take this to the next level and we're going to bring it into the 21st century. You're not telling anything, okay? All you're using is some buzzwords. You've got to give specific examples on what you can do to make this happen, okay? Give a specific example. Here's how we're going to do this, and put all the pieces together, okay? She's not doing that in this interview so far, and that's, you're going to have trouble winning over certainly a lot of more retail investors when you can't give a specific example there, right? Something I think Karp and the team at Palantir do pretty good is they can give specific examples of this on the battlefield, or this is how we can, transform this company's data to help over here. So I just don't feel like Oracle's doing the best job of that right now.
Wanted to modernize it, and we're doing that with all the technology that we have to do it.
I wish people had understood that on the call. I think that was a much more succinct way than the analysts have described it. Can you explain to me, by the way, whether TikTok, which you are involved with, could end up being a big win for Oracle? None of the analysts seem to care, but if we decided in this country that we didn't want TikTok to be controlled by the Chinese, the logical company to win would be Oracle.
Well, for us to remember, TikTok runs in our Oracle Cloud infrastructure. They chose us after competing us with all the others and getting recommendations from other customers of ours, which allow them to run TikTok much more profitably than they would if they were in other clouds. They're in our cloud, and they continue to work with the United States government on security, and we're available to help on that.
Well, I think that that's a great piece of business. The final thing that I would like to know is Oracle trades at a very reasonable price. You repurchased 1.3 million shares last time for 150 million, but you do have the capability, and the cash flow is humongous here, to be able to buy far more stock and be more aggressive if you would like. Even though the stock's up a lot this year, is this a good level for Oracle to be buying stock?
I sure think so. As I've told you all before, we continue our buybacks, and when we get buying opportunities like have opened up in the past week or so, don't think we don't put our money where our mouth is. We've got some pretty significant plans, and of course, our board has given us permission, and of course, I also want to always guard my credit rating, which we've got plenty of room with.
Well, I think we just heard the straight story about Oracle, and I'm glad we did, because I did not feel that the analysts correctly described or articulated what you and Larry are up to. But you have. Safra Katz, Oracle Corporation CEO, thank you for spending the time with us. I really appreciate it.
Thanks, Jim.
That's Safra Katz, and Mad Money will be right back.
Oh, man, too much. Okay, so we spoke about two big problems with Oracle. There's a much bigger problem, okay? So two problems obviously we spoke about is the CEO Safra there, not giving enough of specific examples that I think would be really helpful so people can wrap their head around, what Oracle's up to here, why it matters, why they, differentiate themselves in a substantial way against competitors, right? Larry Ellison selling stock, that's obviously not something people want to see. But the third thing is much bigger than both those by far and away, okay? Oracle has a huge problem. Its debt load is insane. Okay, the balance sheet in this company is not good. That's probably why I haven't started buying this stock yet. I'm really trying to figure out risk reward here, and do I want to get involved with a company that has a bad balance sheet, right? Even if their income statement looks pretty darn attractive and their growth rates look pretty attractive and their valuation looks pretty attractive, do I want to buy a bad balance sheet company, right? And if I buy a bad balance sheet company, then I have to limit my risk. I have to treat a bad balance sheet company very similar to how I would treat an unprofitable company, where the level of investment into that company has to be on the smaller side. You can't take a huge risk in a bad balance sheet. A company like Meta, very easy for me to take a huge risk in that stock. Well, invest a lot of money, great balance sheet and great income statement and attractive valuation, right? That's cake. Oracle, if we don't have the great balance sheet there, that's troubling. Huge debt load, obviously in a higher interest rate environment, not ideal to have a massive debt load like Oracle does. I honestly think Oracle should be paying down debt rather than doing share buybacks. I mean, at the end of the day, like, you don't want to have the sort of debt load Oracle has right now. You want to get that debt paid down. So in my opinion, they should be focused on paying down that debt. That's just my perspective on that, man. Pay down the debt, and I think you'll get in a much better financial situation when it comes to balance sheet, and then you can go from there. The Professor Jeremy Siegel. Let's hear what he has to say in regards to stocks and market into year end here.
Finance at University of Pennsylvania's Wharton School of Business. And Jeremy, let's just talk about this. Even if they're hawkish in their commentary, you don't really think that they should or very likely will raise rates again. Is that right?
Well, there's certainly a lot of uncertainties with the strike, with shutdown of the government, and actually political calculations. Is one increase or two increases, is that the straw that's going to break the camel's back? I really think that the political calculus is that they should not raise it again. I mean, if you'd ask the American public, I think today, the average worker, do you want to squeeze a point or two off of super core inflation, which is what Jay Powell looks at now over the next 2 years, or do you want 1.5 million to 2 million more unemployed? I think they would say, hey, listen, I don't want any recession. So, but they're going to talk, they have to talk hawkish, being the central bank. I think you're going to see the dot plot being hawkish. I think they're going to push those rate cuts, back. Now, they don't know when that really is going to happen. People think, they have an idea about, what the economy is going to look like in 2024.
That's where people just don't understand macroeconomics, unfortunately, right? Because I've heard some people saying, inflation is still too high. Fed should just keep raising. Here's the problem, okay? This is a macroeconomics 101 lesson here, okay? If you keep raising and you put us into a serious recession, massive job losses coming, do you think that's good for people? No. Okay. Here's the other problem. People that have jobs usually make far less in some sort of, especially if it's a big recession, than any other time period. And it takes years to kind of get back to a good place again. So you might think, that sounds great. Like, if gas prices stop going up and, food prices stop going up and the price of the restaurant and all those things, okay, sounds great until you make far less money, right? Until you're making, 50% less than what you made the previous year. Does that do you any good? No. Or what about when you're out of work and then you're on food stamps? Does that do you any good? No, of course not, right? And certainly in the great financial crisis, I knew a lot of people that, there was no good jobs out there. I knew people when I worked at Walgreens that were working as assistant managers, making $35,000 a year, $40,000 a year as an assistant manager at Walgreens, who had college degrees. But there were no other good jobs out there, so that's what they were doing at that time. I know people that, were making $100,000 a year in 2006. By the time we get to 2008, 2009, they're making $50,000 a year. So they were able to keep their job, but they're making half of what they made before. So that's the part that people just, unfortunately, they don't understand. They don't get it. And that's unfortunate because I think it's something important. But that's just people that haven't done studies in macroeconomics over time, or they didn't go through it. Because I always paid attention, so close attention to money and everything that's going on in the economy from basically the time I got in the workforce all the way through, right? I got to see what happened in the great financial crisis. And I got to see the people that were, working dead-end jobs that had college degrees. And I got to see the people that were making great money and then were making crap money in a recessionary environment. And I got to see the foreclosures and the short sales and all that stuff. Other people just haven't gone through it. They haven't paid attention to it, so they are clueless, and it's unfortunate. But it is what it is. It is part of the process. Just understand, you got to be careful what you wish for, because you might just get it.
We don't, but, given the strength of the economy, and that's what the stock market loves. That's why even when we have a slightly hotter PPI, slightly hotter CPI, if we got good, real economic data in there, you see the stock market rally. And that's why I think we could still have a firm, not a surging, but a firm equity market through the end of the year.
If there are some people who think that they're going to have to cut rates sooner rather than later this year, early next year, If that's the case, though, versus the 9 or 10 months that most people are anticipating these rates will stay at these levels, it's going to be because something bad happened. The economy looks worse than anticipated. There's a credit problem. Something blows up in the banking system. Unemployment drops more rapidly. Would you agree with that assessment, at least, that if we get lower rates sooner, it's not going to be because it's a good scenario?
Absolutely. I think the only thing that is going to really push them to lower rates is that unemployment rate going up, a big slowing in the employment picture. Heading into an election year. Wow. I mean, think about the impact of a recession and what's going to happen politically in 2024. I mean, that has to come.
Yeah, if we had a recession in 24, Biden's 100% out. You don't get reelected if you're in a recessionary environment, if your unemployment's rather in the higher place. That's just bottom line with that.
On the center.
Bottom line, you're not getting reelected. If unemployment's climbing significantly, you're not getting reelected.
And by the way, as we all know, the Fed has a dual mandate. It has a mandate for employment and inflation, and one is not above the other. And that's in contrast to most other central banks where they only have that inflation mandate. So, Powell can definitely pivot.
Most Fed heads will get around that by saying, yes, we may have two mandates, but if you don't take care of the first mandate, which is inflation management, then your second mandate can't be taken care of either. It goes hand in glove.
And that's what Powell's saying. But it's a question of time. Do you really want to slam the economy to get that core rate down to 2 really quickly? It's going to go down to 2. So if it takes another 6 months, another year, again, it's all a matter of trade-offs. And by the way, as we all know, are they going to get it all the way down to 2? There's so much debate about, even before the recent inflation, about given the low interest rates that we've had, you may want a 3% inflation target. Now, that's not going to be mentioned by Powell or the Fed. They can't discuss that during this disinflationary period. But the question is, is he going to drive it down to all the way down to 2? In the meantime, Yeah,
and another thing people don't realize or contemplate, if, the Fed hits us too hard and we go into a major recession, is then there's far less tax revenue, right? Which means government deficits are going to get much worse. Also, the Fed has to do quantitative easing. They have to put in all these programs in order to try to pump the economy. And then debt loads go to the sky, much higher than they are today, right? And there's the same people that complain about that. They don't understand how that works at the end of the day. So, this is why the Fed has to be very careful at this point in time, right? Last year, they had their way with just being able to raise interest rates, right? They were way behind and they had to play catch up. Now, at this point in time, the Fed needs to be extremely careful with every move they make, right? And once again, once the Fed starts lowering rates, it might be a bad sign. Let's just put it that way.
Let me just ask you really quickly, because we're almost out of time. We've spent a lot of time talking to you about the Fed. How do you just feel about the markets overall? Is this a market that you would tell people to invest into? Do the levels seem expensive, or does it seem like a fair price?
Absolutely. I mean, you're 19 times next 12 months earnings. And to me, that's a really good deal. That's over 5% after inflation as a long-term return after inflation. And if you buy TIPS bonds, you get less than 2% after inflation. And that margin, if you're a long-term investor, is going to be a very healthy margin to build wealth over the long run.
Yeah, so he brings up a good point there at the end. And in terms of the market in general, my feelings on how the market's valued, are we undervalued, overvalued? I think right now we're pretty fairly valued. I definitely would not call this market undervalued. I definitely wouldn't call this market overvalued. I think we're kind of in fair value range right now, given the state of the economy right now, given the state of earnings right now. I think we're pretty fairly valued. I think there's some large caps that are trading a little rich, no doubt about it. I think there's some small and mids that are trading very undervalued in this market, right? But that's kind of my opinion overall. It's okay. It's an okay time to just buy the market in general. Meanwhile, you dig beneath the surface and you're going to find some companies that are tremendously undervalued in this market right now that are phenomenal opportunities. And you're also going to find some stocks in the market right now that are very overvalued, right? And just aren't very attractive. If I think about a stock like Meta, Meta's undervalued. The stock's gone beast mode, but it's still extremely undervalued. You look at its growth rates and look at its forward P and tell me that's not an undervalued company. And the management team there and the balance sheet is very undervalued stock, right? So there's cases that can be made on very undervalued stocks. We talked about Oracle, right? You could make an argument that that might be a little undervalued as well right now. And there's a lot of obviously small caps, dividend stocks that are very undervalued right now. They're just out of favor. No one wants to hold really any of those big dividend yield stocks. Those are just completely out of favor right now. I might talk more about that on the main channel later today. But yeah, all right, let's hear Ed Yardeni from Bloomberg from a few hours ago here. A return to the old normal for the markets in the U.S. economy. Okay.
See in the previous hour, Ed, and he said we need to focus on what could go right in 2024. Are you more focused on what could go right or what could go wrong?
My view of 2024 is that could be a better year than certainly 2022 was, or even 2023. Not that 2023 is turning out to be a very bad year. As we know, the third quarter is turning out to be remarkably strong. So all in all, I think that we'll get through a lot of these challenges, and 2024 should be a better year for earnings, with the market doing better too.
Ed Yardeni, you and Ralph Enkenfor have been way out front of this on the October rally, and we've talked about a second leg of a bull market. As John mentions, Mr. Kettner of HSBC shares your enthusiasm. The arch pullback of this, is the great moderation over? Is the great moderation over, and does that mean you can't make money in stocks?
Well, I've been really debating in my commentaries about whether it's going to be the great inflation of the 1970s, or it might very well turn out to be the roaring 2020s. And I've been inclined to believe that on a longer term basis, we will see that the 2020s will be a period of tremendous progress and productivity. And I was making that point before the pandemic, and the pandemic sort of got in the way because it really messed up the productivity story big time as people quit left and right. But I think we're making a comeback. I think productivity bottomed actually in 2015. In terms of its growth rate, it was only 0.5% on a 20-quarter trailing basis. I think it's going up to 4% by the end of the decade, which sounds delusional, sounds far-fetched, I'll admit. But those are the kind of peaks we've had in previous growth cycles in productivity, and I think that's where we're heading.
Right. Does a real rate...
I've heard of quite a few people over the past several years really... I think I started first hearing this kind of end of 2021, but talking about 2020s as being like the rolling 1920s, right? Which is kind of scary because then that led to the Great Depression, right? So that's a scary thought as well. And I don't know. I'm not so convinced of that. I mean, that sounds cool. That sounds fun. Like a lot of fun years ahead, right? And I'll be positioned well if that does happen, but I think you got to be careful with kind of going to those sorts of places, especially with interest rates being where they're at right now, right? And the Fed lags potentially catching up to us. We've been very low unemployment for many, many years, to be quite honest. You take out, obviously, the short-term blip from 2020, and to be honest, we've been at super low unemployment now for like 9 years. 9 years, folks. Very low unemployment. So given kind of that backdrop, you know, you're set up for something to potentially eventually break, and I think that's something that has to be considered. So I'm optimistic. I hope Ed Yardeni's right, and a lot of these folks that are predicting the roaring 2020s, that'd be sweet. But I'm not going to bet the farm on that necessarily happening.
And some would say a higher real rate, an inflation-adjusted rate. Does that impinge on your enthusiasm?
Not really. I think we're going back to normal. The new abnormal was the period between the great financial crisis and the great virus crisis. And back then, interest rates were at record lows. I think we're going back to the environment just prior to the great financial crisis, where the TIPS yield was around 2% for the 10-year, and the inflation premium was around 2.5%. So 4.5% is kind of where the bond yield should be in a return to the old normal, and I think that's what we're doing. I think the economy and the stock market have already demonstrated that they can both live with these kind of levels of interest rates.
Interesting. Okay. Yeah. We'll see. We'll see in regards to that, how long kind of things can hold up for and hold strong. So, yeah, I'm always optimistic. I'm always more on the positive side, but, I just get worried about some of these phrases of like the roaring 2020s and things like that. I'm like, let's slow down on that. Okay. Let's not make those sort of predictions, because those are the sorts of things that end up, a year or two later, you come back and you're like, why did I say that? Like, what are we talking about here? Appreciate everybody joining me as always. Thanks so much, folks. Thank you for being subscribed. New all-time high subscribers in the history of the channel. If you've been investing for 3 years or less, make sure you check out pinned comment down there. Get my Investing Foundations free workshop here today. That's going to help you out tremendously. Much love and have a great day.